Let's take the discussion forward on IT space. Sonata Software is the company in focus. Mr. Jagannathan CN, CFO of Sonata Soft, is now joining us. Mr. Jagannathan, thank you very much for joining us. We saw that in the first quarter, the show was slightly on the lower side. How are you really observing demand situation now? Can you tell us on the visibility?
We have to step back and see what was Q4. Q4, there was a degrowth of around 2.4% in revenue. From there, covering that 2.4% and growing by 1.3% was a very good performance for us in this Q1 compared to what it was the situation. As mentioned earlier, the market uncertainties still continue, particularly for large deal. The time frame taken to close the deal and get into a revenue mode is taking still a lot of time. We can't say that everything is hunky dory at present and then things are fallen in place. Having said that, there are green shoots available in few of the verticals. Like for example, high tech. Our largest customer is doing really well. The second area where we see some good traction is in healthcare. Healthcare pipeline is very good and a lot of opportunities have come up, and we see that healthcare is having a good traction for the next few quarters. The other area we see some green shoots is in BFS segment, not in insurance. For us, the insurance is not a very major presence we have. So BFS segment, particularly retail banking segment, we see good amount of traction, good green shoots are visible. I think in a couple of quarters, it will become better. However, retail, which is one of the largest vertical for us, is very soft even today. So that's a major issue we have. And in the offering perspective, Dynamics F&O is a strong area for us.
Okay, so green shoots in high-tech and healthcare, expecting BFSI to turn around in a couple of quarters, but retail continues to be the weak link for you. But what has been strong has been the deal wins. In fact, you backed that large $160 million order as well. How's the deal pipeline looking like right now?
What we see the pipeline is, the pipeline is very, very strong. We reported the book to bill also was 1.24, which is again a very, very strong for us. The opportunity that comes from, particularly with the AI opportunity, all deals at present go with the AI flavor into it. Gen AI flavor in that. Without that, no proposal goes to the customer. Whether it is a 100K proposal or a $500,000 proposal or a $5 million proposal, everything has a AI flavor too. This brings the interest of the customers in bringing and leveraging the technology changes, leveraging AI to make benefit in the business is very, very apparent. However, when it comes to a larger deal, larger than $5 million deal, it becomes a little pulled back from the customer perspective because they don't know whether this is the final technology or something else is going to come in, or can we get something better at a better cost. That's a question I think is going around in their mind. Hence, that deals are taking a little more time. But opportunities are plenty. Pipeline is looking very, very strong. The book to bill is very, very strong. We expect that in a couple of quarters, if the uncertainties on Fed interest rate or a political uncertainties like US presidential election is addressed, we believe that the market may be a little bit more easier to pursue currently.
Right. Mr. Jagannathan, we understand that you have pushed your $1.5 billion revenue guidance also ahead now into FY27 versus FY26, which you had indicated towards. Would you want to elaborate more? What are the circumstances under which you had to do this?
The FY26, we said international business will be $500 million revenue and India business will be $1 billion revenue. We are not that concerned about $1 billion from domestic business. We are still confident that we will be able to meet that. Reaching this in FY26 is slightly difficult. Hence, we said we will. However, international business, considering the slowdown for the last couple of quarters, we may have to consider FY27. The other option available for us is the inorganic growth. We are open to consider inorganic growth, definitely. And we may have to consider an inorganic growth to help us to reach a target of $500 million. But we don't want to be desperate on an acquisition at all. We are ready to get delayed by couple of more quarters rather than being a desperate acquisitions we do. We always think that M&A has to be a strategic fit. And when the right candidate comes at right valuation, we will definitely pursue that. But we may not consider anything just for the sake of size and reach a $500 million. So that's the reason why we told that FY27 is the target date for our moving the target from FY26 to FY20.
Okay, so not too concerned about the $1 billion run rate in domestic business, likely in FY26, but it's the international business which gets pushed to FY27 in terms of $500 million run rate, and you might have to do acquisitions to really push that. Lastly, before I let you go, a word on the margin picture as well, because for a long time it has stayed between that 8 to 9% band. Maybe by the end of the year, should we expect that it will be trending towards at least double digit?
What is that situation is, there are two different businesses are there. One is India business, what we call it as. There the margin improvement, margin as a percentage is not what we are looking, and it will not also improve there. We are always considering evaluating this business on growth of absolute amount of cross contribution, what we get out from the business. So that business have been growing like a gross contribution has been growing more than 20% by average for the last 5 years. And this year, considering that 40% of the revenue comes from IT companies, we are seeing some amount of softness in their business. So there, we believe that with the softness, they may not get that 15% what we committed on VC growth year on year. That may or may not happen for them in this year. We see some amount of softness for that. Parking aside, they cannot improve the margin percentage, but they will definitely grow the GC much faster in the coming years. Coming to the international business, this is a different ball game. We were running at around early 20s EBITDA, and that's what our medium-term guidance also for the business. Temporarily, the business is still at early 20s business. Temporarily, now we are having some challenges on the various factors playing on the giving a covering a cloud over the margin. They will actually we are actually coming out of these, and next 2-3 quarters we expect the margin will be under pressure because we are considering a salary increase in Q2 of this year and Q3 of this year. We expect by end of the year we should reach to the early 20s level. We guide medium term for the international business of early 20s EBITDA without other income.
Right. All right, Mr. Jagannathan, thanks very much for chatting with us and explaining what exactly is happening at the company's end.
If you like this video, then like, share and subscribe to ET Now.